Aloha, this is Joshua Hayes at BigWaveTrading.com for the BigWaveTrading.com 9/30/08 wrap up. Hey, like I said, it never pays to panic. That's why I covered half of my short positions in some stocks, not all. There's a lot of stocks that I have that are just breaking down that I couldn't get rid of, but a lot of stocks like Apple had to be covered in the morning. I want to say one thing though. We need to look at price action closely to get a better read on it. But I just want to make the observation that it's very good that we were able to bounce back 5.27% today on the S&P 500 after the devastating 8.79% loss yesterday. It shows that things aren't as horrible as we may. I know how bad they are in the banks, and I'll tell you right now, it's horrible. Some of the mortgages that are lent out, you can just find some news headlines if you do some searches on the internet and see how bad it is. But anyway, let's get into the charts because that's all really I'm about. Okay, so anyway, so we had yesterday's breakdown on heavier volume, much heavier volume than the prior 4 days. But the problem was is that volume was nothing compared to the volume any time before that in September, June, March, or January. So it's pretty scary that you can break down 9% on volume just a little bit around what used to be average volume around in March. So it's pretty scary that that happened. The good news is we did bounce back, but a key reading, which people don't want to believe in for some odd reason, is look at the lower volume. It's a lower volume bounce. This tells me that this is nothing but a relief bounce. And until this price can take this white line and can take this purple line, there is no way I can get bullish on the S&P 500. At the same time, I can't get bullish on the NASDAQ either. This is the NASDAQ chart. It was wonderful, I think, to see it after a 199-day loss come back 98 points. But once again, notice the volume, whatever. It is smaller than the day before, and it clearly indicates that buyers were not in control like sellers. But once again, referring back to the charts, the volume in September is what it was, much smaller than was in June when it started to break down, in January when the sell-off really started, and in November when the sell-off started. So like I said, to see the market break down 9% like that on volume just above what was like average volume in March, above average volume, but still near average in March, is very scary. Very scary. And tells me that this is not a bottom, but more of a beginning of a more severe downtrend. There will be pullbacks and bounce backs, and I guess there's charts to play. There's one stock that one guy said that I shouldn't be going long, and so far that it begins with the letter U. It's pretty tight, and it's been moving up higher, and it has been working and going long. Looking at other indexes, let's look at the Dow Jones Industrial Industry Average. It came back a nice 485 points today. That should alleviate some of the fear that everything is just going to fall apart and the world is going to come to an end. Like I said, though, the volume yesterday wasn't that much bigger compared to the volume that came in June, came in January, March, and even in July and August, back when it started to sell off in the summer. So like I said, once again, very scary that the market can break down so much on so very little really above average volume. All you need is no buyers. You just need the bidding to go away, and that's what's happening. And today with the lower volume rally, we can see we still have that. Now going to the NASDAQ 100, which is one of the most severely punished indexes yesterday, down 10.52%. It came back a nice 5.91%. Once again, though, volume lighter than the day before. And this shows up constantly everywhere you go. And the volume that was on yesterday, as you can see, was lighter than the volume in June, January, November, and August. Very, very, very scary, in my opinion, that the market can break down almost 11% on just it's very heavy volume, but not extremely heavy volume, not capitulatory volume. That's why I constantly refer that I don't believe the worst is over yet. And as you can see in the Russell, and you can see in the S&P 600, the damage is still there. And now soon the death cross will happen again on the S&P 600. And once again, I need to remind you all, until these price bars are above these lines, the 50 and 200-day moving average, you should not be long stocks. You should not have any long positions whatsoever left. Unless you are forced to be long stocks, you should be out. The one good thing that came yesterday was the jump in the volatility index, all the way up to 48.40 yesterday, where people told me it could never go again. And I told them that was impossible, that it would be there again. Once again, if you want to see what real capitulation is, I'll bring up the 1987 chart and I'll show you that the VIX had a high of 172.79 at the top. So if you want to get really scary, and if you want to really see what a real... What happened there? I didn't mean anything like that to happen. Want to see what a real vicious market could look like? Let's see how the VIX looked whenever that brutal sell-off happened. Let's look at the NASDAQ. Let's look at the okay, let's look at the S&P 500 during the 1987 crash. Look at that. Now imagine what you would have done with that. But now look at the volume. Notice the volume on the 1987 crash, much larger than anything ever seen before. So there was something there. And then the day next, even heavier volume to support it. We don't have that now. And as you can see in the VIX then, on that dreadful day, what happened there? Some odd reason I don't have what I should have up there. I don't know why. Oh, because there it is. Because that wasn't the end of the bear market. Let me bring that up one more time. S&P 500. So you can see what it looked like that day. And as you can see, the VIX hitting all-time highs of 150.19. Intraday high the next day, 172.79 before we bottom. So if you want to see it get crazy, folks, it can get very, very crazy. So we did not have this yesterday. So I do not believe we have washed out. Look at that in 1987. Notice the volume. Notice the money stream. Really break down the red bop and everything. And now let's compare it now to what it looks like. Not that bad, really, overall, does it? Doesn't look that bad, not bad at all. Weeklies look bad. Weeklies look bad, I keep saying. All I'm saying is, as long as these prices remain below the 50 and 200-day moving average, you need to stay out of the stock market. It's not time to short. The bounce needs to go further along before I re-enter some short positions, which I do plan on doing, and it's definitely not the time to be long. This is Joshua Hayes at BigWaveTrading.com coming to you on September 30th, 2008, the day after the great crash of our lifetime. Aloha.